Hi all and welcome back to another video, the first video of 2022 on this channel, and today we're going to be discussing one of the two stocks that I'm planning to do a deep dive on in January and February probably this year, and talk in some detail about what attracts me to this business at the moment. As I said in my previous video, in 2022 I'm focused on adding more quality compounders to my portfolio at hopefully very reasonable prices. But it's not to say that you should only study great compounders when they're selling at, say, visibly cheap prices or distressed prices. That's a rather inefficient and even dangerous way of doing it. I think it was Prabrai that said in a recent university interview that Munger told him you should study great businesses not just with an aim to invest in the company, but to extract learnings from the business and its failures or successes. What's more is that even if the price isn't right at the time, you are well equipped to potentially invest if you like what you see, hopefully with a solid thesis and a lot of background on the company, in the event that the stock drops significantly in the future. And if you don't ever end up investing, then at least you've extracted a lot of learnings and new information that you can potentially take into the next companies you dive deep into. For example, learning about the success and failures of Alibaba, JD, and Amazon and other e-commerce companies allows me to better understand and analyze the business that I'm going to talk about today. And there are plenty more examples of businesses that I've studied and not necessarily invested in, but have helped with knowledge and understanding of other businesses that I have invested in. So the point I'm trying to make here is aim to study great businesses, not just in the hope of investing, but to learn from them. After all, knowledge and learning compounds just like wealth does. And so with that intro out of the way, the first stock I'm looking into and would like to share with you is MercadoLibre. MercadoLibre is the leading e-commerce and fintech company in Latin America. Its business consists of an e-commerce marketplace that's similar in nature to Amazon in the sense that it sells its own inventory and the inventory of others, so that first-party marketplace and third-party marketplace dynamic exists. They have a best-in-class logistics platform for the region as well that is available through MercadoLibre's platform and as an off-platform service for others as well. Then they have a fintech platform that is very similar to a PayPal. And again, it's now available outside of just the MercadoLibre platform. In fact, more than 50% of the TPV, which is total payment volume, was actually off-platform in 2021. And so you have this fully integrated ecosystem that is similar to what Alibaba has in China and how they did so well in China with the three pillars to success in e-commerce, that being the e-commerce marketplace, logistics, and the fintech platform and payments that wrap together very nicely. And it's perfectly suited, in my opinion, for the opportunity-rich Latin America. And so I think when I've looked at MercadoLibre, what's attracted me from a business point of view is a few things. Firstly, its emerging monopoly characteristics and dominant market position. It currently has 30% plus market share in Latin America, and you wouldn't bet against them retaining it. If you look at the money and resources that they're pouring into areas like Chile, they don't yet dominate, and also the money that they're spending on marketing to try and promote all of the platforms that they have. And so I think it's fair to say that MercadoLibre has a deep economic moat. The second thing is they've seemingly reached a point of critical mass and business scale where gross margins are stabilizing and things like payments are starting to contribute meaningful gross profits as they continue to scale them upwards. They can also produce decent margins while still reinvesting heavily back into the platform. I think 9% EBIT margins is great, but understates what's possible for the long term, considering the addition of high margin sales from their third party business and the developing ads business, as well as credit business and things like that. All that will complement the lower margin first-party marketplace. And another point of attraction is definitely the industry tailwinds. Retail e-commerce sales in Latin America are expected to double from 2021 to 2025, reaching $160 billion in 4 years' time. That's 20 to 25% underlying CAGR just for the retail sales of the e-commerce business. Latin America itself is obviously still a very underdeveloped region of the world, and internet penetration for purchasing of goods and things like that is still very low in comparison to, say, the US, Europe, or Asia. But a business like MercadoLibre is enabling the move to digital for many of the population and helping to create a meaningful digital economy in the region. For reference, Argentina, Mexico, and Brazil, which are MercadoLibre's largest markets, were all among the top 10 fastest growing countries for e-commerce in the world in 2020, with year-over-year growth north of 50% in all regions. Payments and credit provide even more opportunity, with a tiny percent of the current population in Latin America even having a debit or credit card, and the growth of the fintech arm is expected to be in the region of 50 to 60% for the foreseeable future, and it's becoming a much bigger part of the total revenue. And so I think we have this mix of huge growth opportunity, great business with good business economics, deep moat and even monopoly-like characteristics that will help capture that growth and preserve those special unit economics. And that's without even talking about the management. Obviously, the CEO is the founder of the business and has skin in the game, and he's managed to get it to where it is today. So that's another element that we haven't even touched on that is a positive with the business. And although from first glance, Mercado Libre does or has seemed quite expensive, it is way down from where it has been trading. And actually, even on a 5-year basis, this is forward price to sales, by the way, it is at a 5-year low. So definitely something that is intriguing. Whether 6 to 7 times forward sales is expensive depends on your view of growth and future margins, obviously. I tend to actually think that Mercado Libre may be able to grow faster than what analyst consensus suggests, and I think margins will expand into the future. But there is much more work that is needed to answer that question with some conviction. However, it would be out of character of me not to show you a hypothetical valuation and look at what Mercado Libre needs to do in order to be a good investment from here. Like I said, don't take these forecasts here as concrete. I'm just demonstrating what it needs to do to be a good investment from what seems to be a distressed price for the company, just going off of previous years' valuations. And so I've got the historical results here. We've got 2019 and 2020. These 2021 numbers are estimates just because we don't have the fourth quarter results yet. So we're taking the analyst consensus estimates for the fourth quarter and just bolting that onto the actual results we have at the moment. I think it will end up being close to this anyway, 6.9 to 7 billion of US dollars in revenue. That's 75% growth year over year. So a very good year for Mercado Libre. They were profitable as well, 9.29% EBITDA margins. That's very good to see for a business that wasn't profitable just 2 years back. And looking forward, these are my forecasts, as you can see here. I've got 35%, just hypothetical for now, CAGR into the future for the next 5 years. Analyst consensus is actually around 45%, so I'm way under what analysts are penciling in. Obviously, there's only a few analysts that are giving out 4 to 5 year estimates, but that is what they look like. I'm going a bit low with 35% on this hypothetical scenario. EBITDA margins to expand to 25%. Like I talked about earlier, the introduction of more high margin products that they have at the moment and these economies of scale that they seem to be having. On gross profit margins of 45% or 47% that they're close to now, and they can definitely, most definitely scale to in the next 4 to 5 years. That would leave them with around 4.5 billion in operating expense room. So I think they'll be able to do that. That gives us 25% EBITDA margins. And then we're just adding a 25 times EV to EBITDA on that in year 5, so in 2026. And that gets us to an estimated market cap of around 115 billion for the business. On Judgment Day, share price target of $2,296. So just over a double from where we are at the moment, which is 1,100. And with my opportunity cost of capital that I like to use, which is 15%, essentially my hurdle rate of return, that means that we are in fair value territory at the moment. We haven't got a margin of safety, so maybe that's something to think about, but we are in fair value territory. So this motivates me to definitely look into the story, look into the business a lot more, and try and find out whether we can actually boost these growth rates up and be comfortable with what analysts are putting in, which is 40 to 45%, which actually shows the business as significantly undervalued. Whether they can actually achieve better or worse margins than what I've penciled in here. Analysts have gone with 25% in 2025, so you just get an idea of what they're thinking. And really what I'm going to be looking at next, and what I want to look into more to try and answer those questions and come up with more conviction on the investment case, is the competitive forces that be. This is a big thing, right? Things like Amazon's and Shopee's plans to expand in Latin America, and what that looks like. And the current competition as well, the legacy competition, if they're able to claw back any market share and what they're doing. That's something that's very important and critical to the thesis and growth of the business at the end of the day. Macroeconomic risks is another thing. Given the currency exchange and differing economic conditions in Latin America, inflation and interest rates, that's going to be a big factor. Definitely something to look into, given they have a large credit portfolio now and it is expanding as well. The next thing is how much operating leverage Mercado Libre has and can sustain. We know that it does have operating leverage. Margins are expanding both on a bottom line basis and a gross profit basis, it seems. That's basically going to give us an idea of whether the 25% EBITDA margins are realistic or not. And I'm going to hopefully do that from looking at past financials. But the other stuff above that, like the competitive forces, will tie into those estimates. And there's much more digging to do. This is just giving you an idea of what I'm going to be looking into, and hopefully you will do the same. So I'll be posting, like I say, a deep dive write-up with my valuation, finalized valuation and price targets for Mercado Libre on the Patreon, and plan to do a deep dive write-up on a new company each month going forward on the Patreon. So if you like what you heard and want to know more, then feel free to go and check out the Patreon and all of the benefits you currently get with it. I'll leave a link down below. But the next video on the other new company that I'll be researching and doing a deep dive on in the coming month will be coming out shortly here on the YouTube channel. So keep an eye out for that. It's another case of quality business with emerging monopoly or dominant traits and big opportunities. So I'm excited to share that all with you soon. But apart from that, thank you all for watching. I will see you all in the next video. Good luck with your investments.